Legal disclaimer. The content presented in this video series is strictly for educational, informational, and entertainment purposes only. It does not constitute financial, investment, tax, or legal advice. Foreign exchange trading, commonly known as Forex, involves a substantial risk of loss and is not suitable for every investor. The high degree of leverage often associated with Forex trading can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any doubts. Historical performance, back-tested results, or case studies shown in this presentation are not indicative of future results. No representation is being made that any account will, or is likely to achieve profits or losses similar to those discussed. By continuing to watch this video, you acknowledge that you are solely responsible for your own financial decisions and due diligence. Every single day, roughly $7.5 trillion changes hands. To put that number into perspective, the New York Stock Exchange, the symbol of American capitalism, home to the titans of industry like Apple, Microsoft, and JP Morgan, trades approximately $20 to $30 billion on a good day. If you combine the entire stock market of the United States, the London Stock Exchange, and the Tokyo Stock Exchange, their combined daily volume would still look like a rounding error compared to the beast we are discussing today. This is not the stock market. This is not the crypto market. This is the market that powers the world. This is the foreign exchange market. But here is the statistic that the gurus on social media, renting Lamborghinis and flashing rented watches, will never tell you. It is known in professional circles as the 90-90-90 rule. 90% of retail traders lose 90% of their capital within their first 90 days. Let that sink in. The odds are statistically stacked against the uneducated participant, with a brutality that is almost designed to wipe you out. The market is an efficient machine for transferring wealth from the impatient to the patient, from the amateur to the professional, and from the uninformed to the institutional giants. So why are you here? Why would anyone step into an arena where the biggest banks in the world, Goldman Sachs, Deutsche Bank, Citi, are the sharks and you are the minnow? Because if you can survive the learning curve, if you can strip away the gambling mentality and treat this like the high-performance business it is, you gain access to the most liquid, accessible, and scalable financial market on the planet. This is not about getting rich quick. If that is what you are looking for, click away now. This series is a deep dive masterclass designed to take you from absolute zero to a functional, risk-aware understanding of how money moves around the globe. We are going to dismantle the myths, analyze the mechanics, and look specifically at how US-based traders can navigate the unique regulations and opportunities of this global landscape. We need to begin by completely restructuring your understanding of what money actually is. In your pocket, you have a dollar bill. You think of it as a store of value. You think this buys me a coffee or this pays my rent. In the world of Forex, money is not a store of value. It is a commodity. Just like oil, just like gold, just like wheat. The value of the US dollar is not static. It is moving, breathing, and fluctuating every single second of every single day based on supply and demand dynamics driven by interest rates, geopolitical stability, trade flows, and macroeconomic data. When you trade stocks, you are buying a piece of a company. You are betting that the company will sell more iPhones or deliver more packages, and therefore the company's value will rise. Forex is different. In Forex, you are not buying a piece of a company. You are buying a share in a country's economy. When you buy the US dollar against the Japanese yen, you are essentially making a macroeconomic bet that the United States economy will outperform the Japanese economy over a specific period. You are acting as a macro hedge fund manager, analyzing the health of nations. Let's break down the mechanics of a trade to demystify the process, because this is where most beginners get confused. You have likely participated in the Forex market without even knowing it. Imagine you are an American planning a vacation to Paris. You go to the currency exchange booth at JFK Airport. You hand the teller 1,000 US dollars. The board behind him says the exchange rate for euro to US dollar is 1.10. He hands you back roughly 909 euros. You have just sold US dollars and bought euros. You participated in the Forex market. Now imagine you fly to Paris but you get the flu. You stay in your hotel room for a week, never spending a dime. You fly back to New York with your 909 euros intact. But while you were sick in bed, something happened. The European Central Bank announced a surprise interest rate hike, and the US Federal Reserve released data showing high unemployment. The euro became stronger, and the dollar became weaker. You go back to the booth at JFK. The rate is no longer 1.10. It is now 1.20. You hand over your 909 euros, and the teller hands you back $1,090. You made $90 simply because you held a different currency while its value appreciated. That is Forex trading in its simplest, most raw form. The only difference between that airport transaction and what professional traders do is the medium and the speed. We do not use exchange booths with high fees. We use electronic brokers that connect us directly to the interbank market. We do not wait for a vacation. We trade price movements that happen in milliseconds. We do not just buy, we can also sell or short a currency we do not even own, allowing us to profit even when an economy is crashing. However, the concept of trading implies that there is a marketplace. If you want to buy stocks, you go to the New York Stock Exchange. If you want to buy wheat futures, you go to the Chicago Mercantile Exchange. These are centralized locations. Forex is unique because it is decentralized. There is no Forex building on Wall Street. There is no central server where all orders go. The Forex market is an over-the-counter, or OTC market. It is a massive electronic network of banks, institutions, and brokers connected to one another. This decentralization is critical to understand because it explains why the market never sleeps. When trading closes in New York at 5 p.m. Eastern Standard Time, the banks in Sydney, Australia are just opening up. As Sydney winds down, Tokyo comes online, then Singapore and Hong Kong. Then the heavyweights in London and Frankfurt open their doors. And finally, the liquidity flows back to New York. This creates a 24-hour cycle, 5 days a week, where opportunities are constantly being generated. For a US-based trader, this offers incredible flexibility, but also incredible danger. The market does not care if you are asleep. It does not care if you are at work. It moves relentlessly. For the US market specifically, the landscape is even more nuanced. Following the 2008 financial crisis, the United States government implemented strict regulations under the Dodd-Frank Act to protect retail traders, essentially to protect you from yourself and from predatory brokers. If you are trading from within the US, you are subject to rules that the rest of the world does not have to follow. You will deal with the CFTC, the Commodity Futures Trading Commission, and the NFA, the National Futures Association. We will cover these regulatory bodies in detail later in the series, because understanding them is the difference between keeping your money safe and having it seized or scammed. We also need to address the pair dynamic. In the stock market, you can simply say, I am buying Tesla. In Forex, you can never just buy dollar. You must always buy the dollar against something else. Currencies are always quoted in pairs. The first currency is the base currency, and the second is the quote currency. If you are looking at the pound sterling to US dollar, the British pound versus the US dollar, and you press buy, you are buying pounds and simultaneously selling dollars. You are betting the pound will get stronger, or the dollar will get weaker. It is a constant push and pull, a tug of war between two national economies. This brings us to the concept of liquidity, a term you will hear constantly. Why does liquidity matter to you? Imagine you own a rare vintage car worth $1 million. You want to sell it today. Can you? Probably not. You have to find a buyer, negotiate, and wait. That is an illiquid asset. Now imagine you have $1 million in euros. You want to turn it into US dollars. You can click a button and it happens in under a second with virtually no change in price. That is liquidity. The Forex market is so deep, so vast, that you can enter and exit positions instantly. This liquidity is what allows for technical analysis to function. Because there are so many participants, millions of traders, thousands of banks, the price movements tend to follow psychological patterns and trends that we can study and exploit. But here is the hook, the open loop that drives the rest of this industry. If the market is efficient, and if the banks have all the power, the algorithms, and the billions of dollars, how does a retail trader sitting in their home office in Ohio or California possibly make money? How do you compete with a supercomputer located 3 feet away from the exchange server? The answer lies in not trying to beat them. The answer lies in tracking them. The professional trader does not predict the future. The professional trader is a forensic analyst of the present. We look for the footprints of the institutional money, the smart money, and we swim in their wake. Over the next 9 segments of this masterclass, we are going to peel back the layers of this industry. We are not just going to look at charts. We are going to look at the geopolitics that drive the charts. We are going to look at the specific trading sessions that favor US traders. We are going to discuss the psychological warfare you must wage against your own brain to avoid becoming part of that 90% statistic. We will explore the mechanics of leverage, how you can control $100,000 worth of currency with only $2,000 in your account, and why that is a double-edged sword that decapitates amateurs. This is not a hobby. It is a profession. It requires the same dedication as law or medicine, but the barrier to entry is deceptively low. Anyone with an internet connection and $500 can open an account. That low barrier to entry is why the failure rate is so high. Most people treat it like a casino. By the end of this series, you will not be most people. You will understand the plumbing of the global financial system. Prepare yourself. Clear your distractions. What follows is the comprehensive breakdown of the largest financial market in human history. Welcome to Forex. To understand the foreign exchange market, you have to visualize a pyramid. This is not a flat playing field where everyone has equal footing. This is a rigid hierarchy, a food chain where the big fish eat the little fish, and the little fish, if they are smart, swim in the slipstream of the giants to survive. In the stock market, all orders theoretically go to a central exchange like the NYSE, and a buy order from a billionaire technically interacts with the same matching engine as a buy order from a college student. In Forex, this is not the case. At the very top of this pyramid sits the interbank market. This is the exclusive club of Tier 1 banks: JP Morgan Chase, Citibank, Deutsche Bank, HSBC, and UBS. These institutions are not just participants, they are the market. According to Euromoney surveys, a handful of these banks control more than 50% of all global foreign exchange volume. They trade with each other directly through electronic brokering systems like EBS or Reuters dealing. When they trade, they aren't trading a few $1,000s. They are trading hundreds of millions, sometimes billions, in a single transaction. They trade to facilitate their own clients' needs, but also for their own speculative proprietary trading desks. The spreads they pay, the difference between the buy and sell price, are microscopic, sometimes non-existent, because they have the highest credit relationships with one another. Below the Tier 1 banks, you have the large hedge funds, smaller regional banks, and massive commercial corporations. Let's look at a practical case study to understand this layer, because it affects the price you see on your screen. Imagine a US-based tech giant. Let's call them TechCorp. TechCorp sells smartphones in Europe. When a customer in Berlin buys a phone, they pay in euros. TechCorp now has millions of euros sitting in a German bank account. But TechCorp needs to pay its software engineers in San Francisco in US dollars. They also need to pay for microchips from a supplier in Taiwan in Japanese yen. TechCorp is not speculating. They don't care if the chart looks bullish or bearish. They have a commercial necessity to sell euros and buy dollars. When a company the size of Apple or General Motors executes a transaction to convert billions of dollars of revenue, that sheer volume moves the market, creates a wave. As a retail trader, your goal is to spot that wave and surf it, not stand in front of it. Then there are the central banks. These are the whales. The Federal Reserve in the US, the European Central Bank, the Bank of Japan. Their participants are not motivated by profit. They are motivated by policy. They intervene in the Forex market to control inflation, stabilize their currency, or manage interest rates. When the Federal Reserve Chairman speaks, the market listens. If the Fed hints that they will raise interest rates, the US dollar typically strengthens. Why? Because global investors want to park their money where it earns the highest yield. If a US bond pays 5% and a Japanese bond pays near zero, trillions of dollars of capital flow out of the yen and into the dollar. This capital flow causes the US dollar to Japanese yen pair to skyrocket. This is why we say that in Forex, you are trading the economic health and policy of nations. Finally, at the very bottom of the food chain there is us, the retail traders. We are the plankton. We trade through retail brokers who act as intermediaries. We do not have access to the interbank market directly because we do not have $10 million in credit lines with Citibank. Instead, our brokers aggregate our orders, or they match them internally, or they pass them on to larger liquidity providers. Because we are at the bottom, we pay a slightly higher cost of doing business, known as the spread. Let's break down the spread, because this is the first hurdle every beginner fails to calculate. Go to your trading terminal. You will see two prices for the euro to US dollar. You might see a bid price of 1.0950 and an ask price of 1.0952. The difference is 2 pips. If you buy immediately, you enter the trade at 1.0952. If you wanted to sell immediately, you would only get 1.0950. This means the second you click the button, you are technically in a loss. You are down 2 pips. You need the market to move in your favor by at least 2 pips just to break even. This is the broker's commission. It seems small, but over thousands of trades, it compounds. Now I used a term there. Pip. You cannot survive in this market without mastering the language of pips. PIP stands for percentage in point, or price interest point. In most currency pairs involving the US dollar, the price is quoted to the 4th decimal place. If the price of euro to US dollar moves from 1.1050 to 1.1051, that is a 1 pip movement. You might be thinking, a movement of 0.0001? That is a fraction of a penny. Why would I care about that? This is where the magic and the danger of the Forex market comes into play. This brings us to the concept of lots and leverage. In the stock market, you buy 1 share of a stock for $100. If it goes up to $101, you make $1. In Forex, we trade in lots. A standard lot is 100,000 units of the base currency. So, if you are trading a standard lot of euro to US dollar, you are controlling 100,000 euros. Let's do the math on that single pip again. If you control 100,000 euros, and the price moves by 0.00011 pip, the value of your position changes by $10. Now, imagine the market moves 50 pips in a day, which is a very standard, boring Tuesday in the Forex market. That is a $500 profit or loss. But wait, you probably do not have 100,000 euros sitting in your bank account to put up for a trade. This is where the US Forex market gets interesting. Your broker provides you with leverage. In the United States, for major currency pairs, regulations typically cap leverage at 50:1. This means for every $1 you have in your account, you can control $50 of currency. To open a standard lot position worth $100,000, you don't need $100,000. You only need roughly $2,000 in margin. The broker lends you the rest for the duration of the trade. This sounds fantastic, right? You put down $2,000, the market moves a measly 50 pips, and you make $500. That is a 25% return on your capital in a single afternoon. You can see why the get-rich-quick marketers have a field day with this. But flip the scenario. Imagine you take that same trade. You buy a standard lot, but instead of going up, the market drops. The Federal Reserve releases a report saying inflation is sticky. The dollar rallies against the euro. The price drops 50 pips against you. You have just lost $500. You lost 25% of your account balance in a few hours because you were wrong about a movement of half a penny. This is why leverage is referred to as a double-edged sword. It magnifies your gains, but it equally magnifies your losses. If you do not understand risk management, leverage will bankrupt you. Professional traders in the US often trade with much smaller sizes. Mini lots, 10,000 units, or micro lots, 1,000 units. To precisely control how much money is at risk per pip, let's visualize a historical example to solidify the power of these players and these mechanics. The year is 1992. The British government is struggling to keep the value of the pound sterling artificially high against the German mark. A hedge fund manager named George Soros analyzes the data. He realizes the UK economy is too weak to support high interest rates. He believes the Bank of England is bluffing. Soros and his fund begin to short sell the pound aggressively. They aren't selling millions, they are selling billions. They are leveraging heavily. The Bank of England fights back. They buy pounds with their foreign reserves to prop up the price. They raise interest rates to crazy levels, 10%, then 12%, then 15% in a single day, trying to squeeze the speculators. But the selling pressure from the market, led by Soros and followed by the rest of the world, is too strong. The Bank of England runs out of money. They capitulate. The pound crashes. Soros makes over $1 billion in a single day. This event is known as Black Wednesday. Why do I tell you this story? Because it proves a fundamental truth about Forex. No one is bigger than the market. Not even a central bank. The collective force of supply and demand determines the price. Your job is not to fight the Bank of England. Your job is to identify when the dam is about to break and position yourself to catch the water. So, we know the players, banks, core central banks, and us. We know the unit of measurement, the pip. We know the vehicle, the lot, and leverage. But looking at a chart of the euro to US dollar is like looking at an electrocardiogram of a patient you have never met. You see the heartbeat spiking up and down, but you don't know why. Is the patient sprinting? Are they having a heart attack? Or are they just sleeping? To trade successfully, you need a methodology to interpret these squiggly lines. You need a way to predict the future probability of price direction. There are two schools of thought in this world. One group obsesses over economic news, GDP reports, and political elections. The other group ignores the news entirely, believing that everything they need to know is hidden within the geometry of the chart itself. Most beginners pick one side and ignore the other, and that is their fatal mistake. In the next video, we are going to step into the war room. We are going to break down the two pillars of forecasting: fundamental analysis and technical analysis. And I am going to show you why the most successful traders in the US market don't choose one, they synthesize both. You are about to learn how to read the mind of the market. Imagine you are planning a cross-country road trip from New York to Los Angeles. To get there successfully, you need two things. First, you need a working vehicle with an engine, fuel, and a transmission. Second, you need a map or a GPS to navigate the roads. In the world of Forex trading, fundamental analysis is the engine. It provides the power, the drive, and the long-term direction. Technical analysis is the GPS. It tells you exactly where to turn, when to speed up, and when to hit the brakes. Let's pop the hood and look at the engine first. Fundamental analysis. This is the study of the underlying economic forces that drive the supply and demand of a currency. When you trade the US dollar, you are not just trading a green piece of paper. You are trading the economic output of the United States. You are trading the decisions of the Federal Reserve. You are trading the geopolitical stability of the superpower. The single most important driver in fundamental analysis, the big boss of the Forex world, is interest rates. You must ingrain this relationship into your mind. Money flows to where it is treated best. If the United States Federal Reserve offers an interest rate of 5% on the US dollar, and the Bank of Japan offers an interest rate of 0% on the yen, big institutional money is going to sell yen and buy dollars. They want that 5% yield. It is known as the carry trade, and it moves trillions of dollars over the long term. But it is not just about the current rate, it is about the expectation of future rates. This is where the economic calendar comes into play. As a US-based trader, there are specific days of the month where you must be glued to your screen, or conversely sitting on your hands doing absolutely nothing to avoid the volatility. Consider the NFP, the Non-Farm Payrolls Report. This data is released by the Bureau of Labor Statistics typically on the first Friday of every month at 8:30 a.m. Eastern Standard Time. It tells us how many jobs the US economy added or lost, excluding the farming industry. Why does this matter? If the US adds more jobs than expected, it means the economy is hot. If the economy is hot, inflation might rise. If inflation rises, the Federal Reserve might raise interest rates to cool it down. Higher interest rates mean a stronger dollar. Imagine you are sitting at your trading station at 8:29 a.m. on a Friday. The euro to US dollar pair has been moving slowly all night. Suddenly, the clock hits 8 hours and 30 minutes. The NFP number is released. It beats expectations. Algorithms from Goldman Sachs to BlackRock react in nanoseconds. The liquidity vanishes. The price on your screen doesn't just move. It teleports. It might jump 50 pips in 1 second. If you were on the wrong side of that trade with high leverage, your account could be blown before you even have time to blink. This is the power of fundamentals. It is the tidal wave that overrides everything else. Other key data points include the CPI, Consumer Price Index, for inflation, and GDP, gross domestic product figures. However, fundamental analysis has a flaw. It is terrible at timing. A country's economy can be strong, but its currency can still drop for a week due to profit-taking or technical corrections. Fundamentals tell you what to buy by the dollar because the economy is strong, but they do not tell you when to buy it. If you buy at the very top of a trend just because the news is good, you might suffer a massive drawdown before the price eventually goes your way. This is where we bring in the GPS, technical analysis. Technical analysis is built on the philosophy that all known information, every news report, every fear, every hope, and every fundamental data point, is already priced into the chart. Technical traders believe that history repeats itself because human psychology never changes. Fear and greed look the same on a chart in 1920 as they do in 2024. The building blocks of technical analysis are the candlesticks. A single candlestick on a chart tells you a story about the battle between buyers, bulls, and sellers, bears, over a specific time period. If you see a candle with a small body and a long wick sticking out the bottom, it tells you that sellers tried to push the price down. but buyers came in aggressively and pushed it back up. That is a rejection. That is a clue. We use these clues to identify support and resistance. Imagine a multi-story building. The floor is support. The ceiling is resistance. If you drop a tennis ball, it hits the floor support and bounces up. If you throw it up, it hits the ceiling resistance and bounces down. Let's apply this to a real-world scenario. Imagine the US dollar to Canadian dollar pair has been falling for weeks. It reaches a price of 1.3000 and suddenly stops falling and bounces up. 2 days later, it drops to 1.3000 again and bounces up again. Why? Because 1.3000 is a psychological round number. Institutional traders see this level as cheap. Orders are stacked there. This is a support level. A technical trader does not care why the price is bouncing. They just see that it is bouncing. They place a buy order at 1.3000 with a stop loss just below it. If the floor breaks, they get out. If it holds, they profit. But technical analysis also has a flaw. It can be a self-fulfilling prophecy, but it can also be a trap. You might see a perfect double top pattern signaling a sell, but if the Federal Reserve Chairman walks out to a podium and announces a surprise rate hike, that technical pattern will get obliterated instantly. The engine fundamentals always overpowers the GPS, technicals, in a head-on collision. So, how do the top 1% of traders, the ones managing millions, actually trade? They synthesize both. They use a top-down approach. Here is the step-by-step workflow of a professional trader. Step 1, they look at the fundamentals to determine the bias. The US economy is strong, and the Eurozone is weak. Therefore, I want to buy dollars and sell euros. They now have a direction. They will only look for buy opportunities on the USD. Step 2. They switch to technical analysis to find the entry. They know they want to buy, but they don't buy blindly. They wait for the chart to pull back to a support level. They wait for a specific candlestick pattern that confirms buyers are stepping in. This synthesis drastically reduces risk. By using fundamentals, you ensure you are trading with the macroeconomic wind at your back. By using technicals, you ensure you are not buying at a peak, getting a good price with a tight invalidation point. Imagine this scenario. The CPI report comes out showing US inflation is dropping. This is generally bad for the dollar because it means the Fed might cut rates. Fundamentally, you are bearish on the dollar. You look at your chart. You see the price approaching a strong resistance level, a ceiling. Now you have confluence. The fundamentals say down, and the technicals say ceiling. This is a high probability trade setup. You are not guessing. You are executing a business plan based on converging evidence. We have covered the why fundamentals and the how technicals. But there is a third variable that is specifically crucial for you, the US-based trader or anyone trading the US markets. That variable is time. The Forex market is open 24 hours a day, but it is not active 24 hours a day. There are specific windows of time where 80% of the volume happens. If you try to trade outside of these windows, you are like a surfer sitting in a calm lake waiting for a wave. It will never come. You will die of boredom, or worse, you will force a trade that isn't there. There is a specific phenomenon known as the overlaps, where two major global sessions are open at the same time. For a trader in North America, understanding these time zones is the difference between trading a sluggish, choppy market and trading a fast-moving, profitable one. In the next part of this masterclass, we are going to dissect the kill zones. I am going to show you exactly what hours of the day you should be sitting at your computer and, more importantly, what hours you should be asleep. We are going to look at the Asian, London, and New York sessions and reveal why the London-New York overlap is the golden hour for making money. The clock is ticking. Let's synchronize your watch. If you try to sell snow shovels in the middle of the Sahara Desert, you will go broke, even if you are the greatest salesman on earth. The product is fine, your skills are fine, but your timing and location are disastrous. The same logic applies to the Forex market. You can have the perfect technical setup, the perfect fundamental bias, and the perfect risk management plan, but if you execute that trade at 5 p.m. New York time, you are dead in the water. You are trying to surf in a bathtub. To navigate this, you must stop thinking of the Forex market as one continuous 24-hour blob. It is not. It is a relay race consisting of 3 distinct runners, each with a completely different personality, volatility profile, and danger level. These runners are the Asian session, the London session, and the New York session. As a trader in the US market, your geography gives you a specific tactical advantage, but only if you align your sleep schedule with the flow of global capital. Let's start with the first runner, the Asian session. This session technically kicks off when the Wellington and Sydney markets open, but the real volume arrives when Tokyo opens its doors around 7 p.m. Eastern Standard Time. For a trader in New York or Chicago, this is your evening. For a trader in Los Angeles, this is late afternoon. The personality of the Asian session is generally calm. It is often referred to as the accumulation phase. The big US and European banks are closed. The primary participants are Japanese exporters, Australian hedge funds, and the central banks of the Asia-Pacific region. Because the volume is lower, the price movements tend to be smaller. If the average daily range of the pound sterling to US dollar is 100 pips, it might only move 20 or 30 pips during the Asian session. For a beginner, this sounds safe. It sounds comfortable. But here is the trap. Because the volatility is low, the market tends to range. It bounces back and forth between a tight floor and ceiling, going nowhere fast. Many US beginners lose money here because they try to force a breakout trade that simply doesn't have the fuel to ignite. They get chopped up, entering and exiting small trades, paying the spread every time, bleeding their account by 1,000 paper cuts. However, professional traders watch the Asian session closely for a different reason. They aren't trading it, they are marking it. They draw a box around the high and low of this session. This is known as the Asian range. This box sets the stage for the violence that is about to follow. The baton is passed at approximately 3 a.m. Eastern Standard Time. Frankfurt opens, followed closely by London at 4 a.m. This is the London session. This is the heavyweight champion of the world. London is the financial capital of the Forex market, handling roughly 35 to 40% of all global transaction volume. When London wakes up, the market explodes. The calmness of the Asian session is shattered. This is where we often see a phenomenon known as the London breakout, or the Judas swing. Imagine the price has been sitting quietly in that Asian box all night. Suddenly, at 4 a.m., the price shoots up aggressively, breaking the Asian high. Amateur traders see this and think, the trend is starting. Buy. They jump in. But this move is often a fake out. The institutional money, the smart money, pushes the price up just enough to trigger the stop-loss orders of traders who were short, and to trap the breakout buyers who are long. Once the liquidity is grabbed, the price reverses aggressively and rockets in the opposite direction. This is the true move of the day. If you are a US trader on the East Coast, this happens while you are sleeping. Unless you are a dedicated night owl or an insomniac, trying to trade the London Open can be physically exhausting and unsustainable. But don't worry, the market saves the best for you. The third runner is the New York session. New York officially opens at 8 a.m. Eastern Standard Time. But the magic doesn't happen in isolation. The magic happens between 8 a.m. and 12 p.m. Eastern Standard Time. This 4-hour window is the holy grail of day trading. It is called the London-New York overlap. Visualize what is happening during these 4 hours. The London bankers are coming back from lunch, looking to close their positions or double down for the afternoon. Simultaneously, the New York hedge funds and banks are drinking their morning coffee, analyzing the data, and entering the market with fresh billions. You have the two largest financial centers in the world open at the exact same time. Liquidity is at its absolute peak. Spreads are at their tightest. Volatility is high, but unlike the Asian session, it is usually directional. If a trend is going to happen, it is going to happen now. For a US-based trader, this is the perfect job. You can wake up, analyze the market, trade the overlap, and be done by noon. You don't need to sit at your screen for 12 hours. In fact, you shouldn't. Let's look at a day in the life case study to make this concrete. Imagine a trader named Alex living in Miami. Alex wakes up at 7 a.m. Eastern Standard Time. He opens his charts. He sees that during the overnight Asian session, the euro to US dollar moved sideways in a 20-pip range. He sees that during the London Open at 4 a.m., the price spiked down, breaking the Asian low, but then quickly recovered. Alex recognizes this as a potential stop hunt or bear trap. At 8:30 a.m. Eastern Standard Time, the US New York session kicks into high gear with a news release. Let's say, retail sales data. The data comes out slightly worse than expected for the US dollar. Because the dollar is weak, the euro should rise. Alex sees the price breaking above the Asian range high. The volume is surging. The London-New York overlap is providing the fuel. Alex enters a buy order. Within 2 hours, the price moves 60 pips. Alex takes his profit at 10:30 a.m. He is done for the day. He caught the wave created by the convergence of time, volume, and data. But there is a dark side to the clock that we must discuss. It is the dead zone. After 12 p.m. Eastern Standard Time, the London bankers go home. They close their books. The liquidity drops off a cliff. The New York session continues until 5 p.m., but the energy is gone. The market often enters a sluggish, drifting state. Statistically, many retail traders give back their morning profits during the afternoon. They get overconfident from their morning win, or desperate from their morning loss, and they keep trading into the low-volume afternoon. They force trades that aren't there. The moves become choppy and unpredictable. If you are trading the euro to US dollar at 3 p.m. Eastern Standard Time, you are picking up crumbs after the banquet is over. Then comes the most dangerous time of all, the rollover. At 5 p.m. Eastern Standard Time, the New York market closes. For about an hour before the Asian markets fully come online, the liquidity dries up almost completely. This is when brokers calculate swap or rollover fees, the interest paid or earned for holding a position overnight. During this 5 p.m. to 6 p.m. window, spreads can widen dramatically. You might see the spread on euro to US dollar go from 1 pip to 10 pips instantly. If you have an open trade with a stop loss that is too close, you can get stopped out simply because the spread widened, not because the price actually moved against you. Professional traders never, ever open new positions during the rollover hour. They either close their trades before 5 p.m., or they ensure their stops are wide enough to survive the gap. So we have established the who, the institutions, the what, currencies, the why, fundamentals/technicals, and the when, the overlap. You are mentally prepared. You understand the battlefield. But you cannot enter the battlefield without a weapon and a portal. You cannot just walk into a bank and shout, "I buy euros." You need software. You need data feeds. You need a broker. And this is where the US market becomes a minefield. The United States has some of the strictest financial regulations on the planet. If you go on Google and search best Forex broker, you will see lists of companies that are illegal for you to use. You will see offers for 500:1 leverage that are banned in the USA. If you send your money to an unregulated offshore broker because they promised you a bonus, you might as well light that money on fire. There is no FDIC insurance here. If they disappear, your money disappears. In the next section, we are going to navigate the regulatory maze of the CFTC and NFA. I am going to teach you how to spot a scam broker from a mile away, how to choose a legitimate US regulated platform, and we are going to open the hood of the trading software itself. We are going to look at MetaTrader, TradingView, and the tools you actually need to execute the trade. The theory is over. It is time to get technical. Welcome to the walled garden. If the global Forex market is the Wild West, the United States Forex market is a high-security vault with armed guards, metal detectors, and a list of rules so long it would make a lawyer dizzy. This is not an accident. This is a direct response to decades of scams, fraud, and financial carnage that plagued the industry before the government stepped in. If you are trading from within the United States, or if you are a US citizen living abroad, you do not have the freedom to just pick any broker you see on Instagram. You are legally required to trade with a broker that is registered with the CFTC, the Commodity Futures Trading Commission, and is a member of the NFA, the National Futures Association. This is your first and most critical test. Before you deposit a single penny, you must perform a background check. It is not optional. Here is the exact step-by-step process. Go to the NFA website and find their system called Basic Background Affiliation Status Information Center. Every legitimate US broker has an NFA ID number. It is usually a 6 or 7-digit code, listed at the bottom of their website. You copy that number. You paste it into Basic. If the search returns no data, close the tab immediately. You are looking at a ghost. If it returns a result, you need to look for one specific phrase: NFA member approved. You will also see a history of regulatory fines. Yes, even the big guys get fined. Read them. See if they were fined for a clerical error or for manipulating client funds. This is your due diligence. This is you acting like a CEO, not a gambler. Now, why does the US government care so much? To protect you from the offshore trap. You will inevitably stumble upon brokers located in islands you have never heard of. St. Vincent and the Grenadines, the Seychelles, Vanuatu. They will target you with dazzling ads. 1000:1 leverage. No pattern day trading rules. 100% deposit bonus. Let's play out an imagine if scenario. You succumb to the temptation. You deposit $5,000 into an unregulated offshore broker, Because they promise to double your deposit to 10,000. You trade well. You turn that 10,000 into 20,000. You feel like a genius. You go to the withdrawal page. You request your money. Suddenly, the support chat goes silent. You get an email asking for a notarized utility bill from 3 years ago. You provide it. Then they say your trading style violated clause 48.2 of their terms of service. They freeze your account. Who do you call? The police in Vanuatu? The CFTC? The US government has no jurisdiction there. Your money is gone. It was gone the moment you sent it. The bonus was the bait and you were the catch. Stick to NFA-regulated brokers. Your funds are segregated in US banks, and there is legal recourse if things go wrong. However, safety comes with a price. US regulations enforce 3 specific rules that you will find annoying, but you must learn to navigate them. Rule number 1, the leverage cap. We discussed this earlier. In the US, your leverage is capped at 50:1 for major pairs like Euro to US dollar and 20:1 for exotic pairs. The offshore brokers offer 500:1. They tell you 50:1 is too low to make money. This is a lie. 50:1 is plenty. If you are maxing out 50:1 leverage, you are already taking on suicidal risk. The cap is like a speed governor on a Ferrari. It prevents you from driving 300 miles per hour into a brick wall. Rule number 2, FIFO. First in, first out. This is unique to the US. Imagine you buy one lot of US dollar to Japanese yen at 10 a.m. The price drops, so you buy another lot at 2 p.m. to get a better entry price. Suddenly, the price spikes up. Your 2 p.m. trade is in huge profit, but your 10 a.m. trade is still slightly negative. You want to close the 2 p.m. trade to bank the cash. The broker says access denied. Under FIFO rules, you must close the oldest position first. You have to close the 10 a.m. trade before you can touch the 2 p.m. trade. It forces you to be disciplined with your entries and prevents you from managing multiple positions in the same pair independently. Rule number 3, no hedging. In the rest of the world, you can buy Euro to US dollar and sell Euro to US dollar simultaneously in the same account. You might do this to lock in a loss while waiting for news. In the US, this is illegal. If you are long one lot and you execute a short order for one lot, the broker will not open a new sell position. They will simply close your buy position. The orders cancel each other out. This prevents a practice that regulators view as deceptive and financially inefficient, as you would be paying the spread twice for zero net exposure. Once you have selected a regulated broker and accepted the rules, you need the cockpit. You need the software. There is a massive divide in the industry here. There is the software you use to think and the software you use to act. For thinking, analyzing, and charting, the gold standard is TradingView. It is browser-based, beautiful, fast, and has data from every market on Earth. This is where you will spend 90% of your time. You will draw your support and resistance lines here. You will check the news here. It is the visual interface of the modern trader. But for acting, for actually pushing the button to trade, TradingView is often not enough. You need to connect to your broker. Enter the dinosaur that refuses to die, MetaTrader 4, MT4, or its younger brother, MetaTrader 5, MT5. When you download MT4, you will think you have traveled back in time to Windows 98. The interface is gray, clunky, and ugly. The charts look blocky. The sound effects are retro beeps. You will wonder, why does a $7 trillion market run on this ancient technology? The answer is reliability. MetaTrader is the AK-47 of trading platforms. You can drop it in the mud, run it over with a tank, and it will still fire. It uses very little computer memory. It rarely crashes. It connects directly to the broker's server with minimal latency. It also supports expert advisors, EAs, automated trading robots that millions of traders use. So, here is the professional workflow you will likely adopt. You have TradingView open on one monitor, or one half of your screen. This is your map. You see the price hitting your zone. You see the candlestick rejection. You decide to trade. You do not execute on TradingView. You alt-tab to MetaTrader. You have your one-click trading panel open. You input your lot size. You hit buy. You hear the confirmation sound. You are now live. You are exposed to the market. At this exact moment, a chemical reaction occurs in your brain. Dopamine and cortisol flood your system. Your heart rate increases. You are no longer looking at a chart. You are looking at your P&L, profit and loss, ticking up and down. Plus $50, minus $20, plus $100, minus $300. This is where the technical skills you learned, the support, resistance, leverage, pips, become irrelevant, and a new beast takes over. You have the car, the software, you have the license, the broker, and you are on the highway, the market. But you do not know how to drive in traffic yet. You do not know the math of survival. Most beginners think the secret to trading is knowing what to buy. That is false. A monkey throwing darts at a newspaper can pick a winning stock 50% of the time. The secret to trading, the thing that separates the millionaire from the bankrupt amateur, is knowing how much to buy. It is the science of risk management. If you risk 10% of your account on a single trade, you are a gambler and you will go to zero. It is a mathematical certainty. If you risk 1%, you are a professional. But how do you calculate that? How do you know exactly how big your position should be so that if you are wrong, you only lose the price of a coffee, but if you are right, you pay for your rent? In the next video, we are going to leave the software behind and open a spreadsheet. I am going to teach you the most boring, unsexy, and absolutely vital concept in finance: position sizing and risk-to-reward ratios. This next 10 minutes will save you more money than you will earn in your first year. Get your calculator ready. We are doing the math that saves your life. Let's begin this session with a math problem that will terrify you. It is called the mathematics of ruin. Imagine you have a trading account with $10,000. You take a trade with bad risk management, and you lose 50% of your account. You are now down to $5,000. The question is, what percentage gain do you need to get back to your original $10,000? Most beginners instantly answer 50%. They think, I lost 50%, so I need to make 50% back. This is dead wrong. If you make 50% on your remaining $5,000, you only gain $2,500. You are now at $7,500. You are still down. To get from $5,000 back to $10,000, you need a 100% gain. You have to double your money just to break even. If you lose 90% of your account, leaving you with $1,000, you need a 900% gain just to get back to the starting line. Shutterstock. This is the drawdown trap. The deeper the hole you dig, the exponentially harder it becomes to climb out. This is why rule number 1 of professional trading is not make money. Rule number 1 is protect capital. If you run out of chips, you cannot play the game. To avoid the drawdown trap, you must religiously apply the 1% rule. This rule states that you never, under any circumstances, risk more than 1% of your total account balance on a single trade idea. If you have a $10,000 account, your maximum risk on any single trade is $100. That is it. If you lose that trade, you are down to $9,900. Your next trade risk is 1% of the new balance, which is $99. If you lose 20 trades in a row, which is actually quite difficult to do if you are trying, you would still have over 80% of your capital left. You are still in the game. You can still recover. But here is where the mechanics get tricky. How do you actually risk exactly $100? You cannot just click a button that says, risk $100. You have to translate that dollar amount into a lot size, based on where your stop loss is located. This is the skill of position sizing. Let's walk through the formula. It is risk amount divided by stop loss distance in pips times pip value. Let's visualize two different trades to prove why standard lot sizing, where you always trade the same size, is a recipe for disaster. Scenario A. You are trading euro to US dollar. The market is volatile. You spot a setup, but because the market is swinging wildly, your technical analysis tells you that your stop loss needs to be 50 pips away to be safe. You have a $10,000 account. You want to risk 1%, $100. Math. $100 divided by 50 pips equals $2 per pip. In standard lots, $10 per pip is 1.0 lot. So $2 per pip is a 0.20 lot size. You enter the trade with 0.20 lots. If the price hits your stop, you lose exactly $100. Scenario B. You are trading US dollar to Japanese yen. The market is very quiet and tight. You spot a setup where your stop loss only needs to be 10 pips away. You still want to risk the same 1%, $100. Math. $100 divided by 10 pips equals $10 per pip. To risk $100 over a 10 pip distance, you need to trade a significantly larger size. $10 per pip is a 1.0 standard lot. In scenario A, you traded 0.20 lots. In scenario B, you traded 1.0 lots. In both cases, the risk was identical, $100. This is the hallmark of a professional. The professional adjusts their size to fit the market conditions. The amateur tries to force the market to fit their fixed size. If you had used a 1.0 standard lot in scenario A, the 50 pip stop, you would have lost $500, 5% of your account in one hit. Do that a few times and you are mathematically ruined. Now that we have capped our downside, let's talk about the upside. This is where the magic of the risk-to-reward ratio, RR, comes in. This concept is the only reason retail traders can compete with banks. In school, you are taught that 90% is an A, 80% is a B, and anything below 60% is a failure. In trading, you can fail 70% of the time and still become a millionaire. It sounds counterintuitive, but let the math speak for itself. Let's say you adopt a strict risk-to-reward ratio of 1 to 3. This means for every dollar you risk, you aim to make $3. If your stop loss is 20 pips, your take-profit target must be 60 pips. You do not touch the trade unless this ratio exists. Imagine you take 10 trades with this strategy. You are having a terrible week. You are wrong 7 times. You lose 70% of your trades. 7 losses x $100 risk equals minus $700. However, you won 3 trades. 3 wins x $300 profit equals plus $900. Net result, plus $900 wins, minus $700 losses, equals plus $200 profit. You were wrong 7 times out of 10. You got an F on your report card, but your bank account grew. This is the holy grail. You do not need to predict the future perfectly. You just need to ensure that your winners are mathematically larger than your losers. Contrast this with the scalper mentality that many beginners fall for. They risk $100 to make $100, a 1-to-1 ratio. Or worse, they risk $100 to make $50 because they just want a quick win. If you risk $100 to make $50, a 2-to-1 inverse ratio, you need a 67% win rate just to break even. You have to be right almost all the time. The pressure is immense. One bad loss wipes out 2 or 3 wins. That is a stressful losing game. This leads us to the concept of expectancy. Positive expectancy is the mathematical formula that hedge funds use to determine if a strategy is viable. The formula is win % x average win size, loss % x average loss size. If the number is positive, you have a business. If it is negative, you have a gambling habit. Let's calculate the expectancy of the 1:3 strategy we just discussed. 30% x $300, 70% x $100, $90 to $70 equals $20. This means that, on average, every time you push the button, you are making $20 regardless of the immediate outcome of that specific trade. Over 1,000 trades, the law of large numbers ensures you will be profitable. However, there is a catch. There is always a catch. Achieving a 1 to 3 risk-to-reward ratio requires patience. It requires holding a trade through the ups and downs until it hits that distant target. It requires watching a trade go into profit, then pull back to break even, and resisting the urge to close it early out of fear. This is where the math ends and the biology begins. You can have the position size calculated perfectly on your spreadsheet. You can have the 1 to 3 ratio mapped out on your chart. But when that candle starts moving and you see your P&L swing from plus $200 down to plus $50 in 2 seconds, your amygdala, the lizard brain responsible for the fight or flight response, hijacks your prefrontal cortex. You panic. You close the trade early for a $50 profit because you never go broke taking a profit. But you just broke your math. You turned a 1:3 trade into a 1 minute and 0.5 seconds trade. You destroyed your positive expectancy. The math works on paper, but it fails in the hands of a human being who cannot control their emotions. We have built the car, the platform. We have the map, analysis. We have the fuel, capital. We have the safety belt, risk management. But now we have to deal with the driver, you. The biggest threat to your trading account is not the Federal Reserve. It is not the high-frequency trading algorithms. It is the person staring back at you in the mirror. In the next part, we are going to conduct a psychological autopsy. I am going to explain why your brain is hardwired to lose money in the markets, and I will give you the specific mental frameworks used by Navy SEALs and high-performance athletes to override that biological programming. The hardest part is not the chart. It's the discipline. Your brain is a survival machine that has evolved over 200,000 years to keep you safe in the African savanna. It is designed to identify threats, like a rustle in the bushes or a predator on the horizon, and immediately trigger a chemical response that forces you to run away or fight. This is the fight or flight mechanism. It is perfect for surviving a tiger attack. It is absolutely catastrophic for surviving the Forex market. When you enter a trade and the price immediately moves against you, your brain does not see a red line on a chart. It sees a threat to your resources. Sees a tiger. Your amygdala, the primitive emotional center of your brain, hijacks your control center. It floods your bloodstream with cortisol and adrenaline. Your heart rate spikes. Your palms sweat. Your vision literally tunnels. In this state, your prefrontal cortex, the logical part of your brain that understands math, probabilities, and risk management, shuts down. You are physically incapable of making a rational decision. This biological mismatch is why smart people make stupid trading decisions. You might be a successful doctor, an engineer, or a business owner, but the moment you lose money, you revert to a primitive state. To become a professional trader, you must essentially rewire your biology. You have to learn to feel fear and do nothing. You have to learn to lose money and feel nothing. Let's analyze the 3 specific psychological viruses that infect every beginner: loss aversion, FOMO, and the God complex. First, let's talk about loss aversion. Nobel Prize-winning psychologists Daniel Kahneman and Amos Tversky proved that the pain of losing $100 is psychologically twice as intense as the pleasure of gaining $100. We are hardwired to avoid pain more than we seek gain. How does this manifest on a chart? Imagine you are in a buy trade on the pound sterling to US dollar. The price starts dropping. It hits your invalidation point, the place where you said you would exit. But you don't click the close button. Why? Because closing the trade makes the loss real. As long as the trade is open, your brain clings to hope. You tell yourself, it will bounce back. I just need to give it more room. You move your stop loss further away. You add more money to the losing position to average down. This is the cardinal sin of trading. You are feeding a loser. Eventually, the market moves so far against you that your broker issues a margin call and forcibly closes your trade. You lost 50% of your account because you were too afraid to lose 1%. Conversely, when you are in a winning trade, that same fear kicks in. You see a profit of $50. Your brain screams, take it. Grab the food before it disappears. You close the trade early for a small win. 10 minutes later, the price explodes in your direction, and you would have made $500. You cut your winners short to relieve anxiety, and you let your losers run to avoid pain. This is the inverse of profitability. Next is FOMO, fear of missing out. In the US market, we are bombarded with success stories. You see a screenshot on Twitter of someone making $10,000 on a gold trade. You open your chart. You see gold is vertical. It has already moved 200 pips. Your brain says, everyone is getting rich except me. I have to get on this train. You buy at the very top of the candle. You are chasing the price. But markets move in waves, expansions and retracements. The moment you buy, the initial buyers, the ones who got in early, start taking their profits. The price collapses. You bought the top. You are now bag holding a position that is underwater immediately. The professional trader waits for the bus to come to the stop. The amateur chases the bus down the street and gets run over. The third virus is the most dangerous because it feels good. The God complex or euphoria. You win 3 trades in a row. You feel invincible. You think you have solved the market. You think you have a special intuition. Because you feel safe, you stop checking your risk calculator. You double your lot size. I can't lose, you think. The market is a humbling machine. It waits for you to get arrogant, and then it delivers a black swan event. A sudden, unpredictable crash that wipes out all your previous wins plus your original capital. This leads to revenge trading. You get angry. You feel like the market stole from you. You open a new trade immediately, not because you see a setup, but because you want to hurt the market back. You are trading on tilt. This is how accounts go to zero in a single afternoon. So how do we cure this? We cannot remove the emotions. We are human, not robots. But we can build a framework to contain them. We look to the casino model. Think about a casino in Las Vegas. They have a roulette wheel. They know that mathematically the house has a slight edge, let's say 5.26%. They do not know if the next spin will be red or black. They do not care. They know that over 1 million spins, that 5.26% edge will generate billions of dollars. The casino floor manager does not panic when a player wins a jackpot. He doesn't scream, "Get the money back." He smiles and offers the player a free drink because he knows the math will win in the end. You must become the casino. You must stop trying to predict the outcome of the next trade and start focusing on the outcome of the next 100 trades. This is called thinking in probabilities. When you accept that any individual trade is just a random event with a statistical probability, the fear disappears. If you lose a trade, it doesn't mean you are stupid. It doesn't mean the market is rigged. It just means the ball landed on red when you bet on black. It is just data. You take the loss, you record it, and you execute the next trade with the exact same discipline. To enforce this detachment, professional US traders use a tool known as the circuit breaker. This is a hard rule you write down. For example, if I lose 2 trades in a row, or if I lose 3% of my account in a single day, I am done. You literally turn off the computer and leave the house. Why? Because after 2 losses, your psychological capital is depleted. You are vulnerable to revenge trading. By walking away, you protect your account from your own sabotaging psychology. You live to fight another day. Furthermore, we utilize the checklist. Pilots use checklists because they cannot rely on memory when an engine fails at 30,000 feet. Surgeons use checklists to ensure they don't operate on the wrong leg. Traders must use checklists to ensure they don't trade on impulse. Before you click buy, you must physically tick off boxes. Is the trend in my favor? Is the price at a support level? Is the risk-to-reward ratio at least 1:3? Is there any high-impact news in the next hour? Am I emotionally calm? If you cannot check every single box, you do not trade. You sit on your hands. Boredom is your friend. Excitement is your enemy. If you are feeling an adrenaline rush while trading, you are gambling. Good trading should be boring. It should be as exciting as watching paint dry or a bricklayer laying bricks. It is a repetitive execution of a proven edge. There is a state of mind called the zone, popularized by the late Mark Douglas. In the zone, you are in complete harmony with the market. You are not imposing your will on the price. You are flowing with it. You don't hesitate to enter, and you don't hesitate to exit. You are an observer of flow. This state only comes when you have completely accepted the risk. You have to truly accept that the money you are risking is already gone the moment you place the trade. If you cannot accept the loss before it happens, you will never be able to manage the trade when it is live. We have now covered the mechanics, the math, and the mind. You have the components of a professional trader. But a pile of car parts is not a car. You need to assemble them into a coherent, drivable vehicle. You need a document that ties this all together. You need a business plan. In the corporate world, no bank would lend you money without a business plan. Yet, millions of traders put their life savings into Forex without writing down a single rule. In the next section, we are going to build your trading plan. This is not a generic document. This is your constitution. We will define your specific trading style. Are you a scalper, a day trader, or a swing trader? We will define your specific currency pairs. We will write the laws that you will swear to uphold. This document is the only boss you will ever have. Let's write it. If you walked into a bank and asked for $1 million loan to start a restaurant, the first thing the loan officer would ask for is your business plan. If you told him, "I don't have a plan, I'm just going to figure it out as I go because I have a gut feeling about burgers," he would laugh you out of the building. Yet, millions of Americans take their hard-earned savings, open a Forex brokerage account, and start trading without a single page of written documentation. They are treating a multi-trillion-dollar financial war like a scratch-off lottery ticket. This is why they fail. Your trading plan is not a suggestion. It is a legal contract between your present self and your future self. It defines exactly who you are in the market. In the Forex world, there are 3 distinct species of traders. You must identify which species you belong to immediately, because if you try to act like a species you are not, you will be eaten alive. The first species is the scalper. Scalping is the Formula 1 racing of trading. It is high speed, high intensity, and high stress. A scalper operates on the 1-minute and 5-minute charts. They are looking to snatch 5, maybe 10 pips out of the market and get out. They might take 10, 20, or 50 trades in a single day. Imagine this scenario. You are a scalper. It is 8:05 a.m. New York time. You see the euro to US dollar tick up. You buy. 2 minutes later, it moves 6 pips in your favor. You close immediately. You made $60. 3 minutes later, you short. You lose 4 pips. You are out. This requires an intense laser-like focus. You cannot blink. You cannot go to the bathroom. You cannot have a full-time job while doing this. For the average US trader with a 9-to-5 career, scalping is usually a death sentence. Why? Because of the spread. If you are targeting 5 pips of profit, and the broker charges you 2 pips of spread, you are starting every race with a 40% handicap. You have to be right nearly 80% of the time just to break even. Unless you have the reflexes of a fighter pilot and the discipline of a monk, do not start here. The second species is the day trader. This is the most popular category for US-based retail traders. A day trader opens positions and closes them within the same 24-hour cycle. They never hold a trade overnight. They sleep soundly because they have zero exposure when their head hits the pillow. The day trader typically operates on the 15-minute or 1-hour chart. They are not looking for 5 pips. They are looking for the daily range, usually 20 to 50 pips. They are trying to catch the single biggest wave of the day. For a trader living in the Eastern or Central time zones, this lifestyle is manageable. You can wake up at 7 a.m., analyze the charts during the London-New York overlap, place your trades by 9 a.m., and then go about your day. You let the market do the work. You check your phone at lunch. You are either in profit or you stopped out. This offers a balance between action and freedom. The third species is the swing trader. This is the sniper approach. A swing trader does not care about the noise of the 1-minute chart. They operate on the 4-hour, daily, and weekly charts. They hold trades for days, sometimes weeks. They are trying to capture massive moves, hundreds of pips, driven by fundamental shifts in the economy. Imagine you are a swing trader. It is Sunday night. You spend 2 hours analyzing the major pairs. You see that the British pound is approaching a major historic support level on the weekly time frame. You place a limit order to buy if it hits a specific price. You go to work on Monday. You don't even look at the chart. On Tuesday, your order triggers. On Wednesday, the price fluctuates. You don't care. On Friday, the price rallies 200 pips. You close the trade. This is the ideal style for someone with a demanding career, a family, or limited screen time. It requires the least amount of effort but the highest amount of patience. The downside? You have to pay swap fees for holding overnight, and you have to stomach the volatility of news events happening while you sleep. Once you choose your species, you must write the Constitution. This is a physical document, printed out and taped to your wall, that dictates your engagement rules. It must be written in if-then syntax, just like computer code. Algorithms dominate this market because they have no emotions. Your plan is your attempt to become algorithmic. Your plan must contain the following 4 clauses. Clause 1, the setup criteria. You must explicitly define what a trade looks like. You cannot say, I will buy when it looks low. That is subjective. You must say, I will only buy if the price is above the 200-day moving average, and the relative strength index, RSI, is below 30, and a bullish engulfing candle closes on the 1-hour time frame. If all 3 of those things do not happen, you do not touch the mouse. You are a machine waiting for a specific input. Clause 2. The risk parameters. We discussed this. I will never risk more than 1% of my equity. I will never take a trade with less than a 1 to 2 risk-to-reward ratio. I will stop trading for the week if I lose 5% of my account. These are hard stops. They are non-negotiable. Clause 3. The time of day. I will only trade the pound sterling to US dollar between 8 a.m. and 11 a.m. Eastern Standard Time. Why? Because outside of those hours the volume is low, and the setup might be a trap. By restricting your time, you increase your probability. Clause 4. The universe of assets. I will only trade euro to US dollar, pound sterling to US dollar, and US dollar to Japanese yen. Beginners try to trade 20 pairs. They trade the Mexican peso, the Turkish lira, and gold all at once. They get overwhelmed. Each pair has a unique personality, based on the banks that trade it. Master 1 or 2 pairs before you try to conquer the world. Now you have a plan. It looks perfect on paper. But does it work? You do not find out by depositing real money. That is financial suicide. You find out by backtesting. Backtesting is the unglamorous, tedious grunt work that separates the pros from the dreamers. You use a platform like TradingView, which has a bar replay feature. You go back in time to January 1st of the previous year. You hide the future data. You scroll forward 1 candle at a time. You wait for your if-then setup to appear. When it does, you simulate the trade. You record the result in a spreadsheet. Then you scroll forward again. You do this 100 times. You do it for the year 2022. You do it for 2023. After hundreds of simulated trades, you look at your spreadsheet. Does the strategy make money? What is the win rate? What is the max drawdown? The longest losing streak you had to endure. You might discover that your brilliant strategy actually loses money 60% of the time and would have wiped out your account in March. Congratulations! You just saved yourself thousands of real dollars. You tweak the plan. You adjust the stop loss. You test again. This is the scientific method applied to finance. You form a hypothesis, the plan. You test it against data, backtesting. And you analyze the results. Only when you have a strategy that has proven profitable over historical data do you earn the right to forward test. Forward testing, or paper trading, is the dress rehearsal. You open a demo account with your broker. It uses real market data but fake money. You trade your plan live for 1 month. Why is this different from backtesting? Because in backtesting you can speed up time. In paper trading you have to wait. You have to deal with the emotions of waiting for a trade setup that never comes. You have to deal with the temptation to break your rules because you are bored. If and only if you can stay profitable and disciplined in a demo account for 3 consecutive months, then you are ready to deposit real capital. I know what you are thinking. 3 months? I don't want to wait 3 months. I want to make money now. The market will be here in 3 months. The question is, will you? The graveyard of Forex is filled with traders who skipped the demo phase because they were in a rush. They paid for their education with their losses. But let's assume you have done the work. You have the plan. You have the backtest. You are trading live. You take a trade and you lose. You take another and you win. How do you know if you are actually getting better? Or if you are just getting lucky? You cannot improve what you do not measure. The final piece of the professional infrastructure is the trading journal. But I am not talking about a diary where you write, "Dear diary, I felt sad today." I am talking about a forensic database of your performance. In the next section, we are going to build the black box of your trading business. I am going to show you the specific metrics you need to track. Metrics like maximum adverse excursion and time in trade. That will reveal the hidden leaks in your bucket. We are going to turn your trading history into a heat map of your own behavior, allowing you to optimize your strategy with surgical precision. In the aftermath of a plane crash, investigators do not guess what happened. They do not ask the passengers for their opinions. They hunt for the flight data recorder, the black box. This indestructible device records every control input, every altitude change, and every system warning prior to the disaster. It provides the cold, hard data required to ensure the crash never happens again. Your trading journal is your black box. Without it, you are flying blind. You might think you know why you are losing money. You might say, "I'm just unlucky," or "the market is choppy." But your memory is a biased narrator. It protects your ego. It remembers the one time you caught a massive trend and conveniently forgets the 10 times you revenge traded your profits away. To become a profitable trader in the highly competitive US market, you must stop trusting your memory and start trusting your data. A professional trading journal is not a notebook where you scribble, "Bought euro to US dollar, made $50. That is useless. A professional journal is a spreadsheet or a specialized software database that tracks rigorous metrics. Beyond the basics of entry price, exit price, and lot size, you must track the vital signs of your strategy. The first vital sign is time of day. You might believe you are a terrible trader, but if you segment your data, you might discover something shocking. Let's look at a hypothetical case study of a trader named Michael from Chicago. Michael feels like he is failing. He is breaking even after 6 months. He feels like quitting. But when we run his journal through a data analyzer, we see a pattern. Between 8 a.m. and 11 a.m. Eastern Standard Time, the New York morning session, Michael has a win rate of 65% and a profit factor of 2.5. He is actually an elite trader during the morning. But between 1 p.m. and 4 p.m. Eastern Standard Time, the afternoon session, his win rate drops to 30%. He is giving back all his morning profits in the afternoon sludge. Michael doesn't need a new strategy. He doesn't need to learn more technical analysis. He simply needs to stop trading after lunch. The data revealed a leak that was invisible to his naked eye. By simply instituting a hard stop at 11 a.m., Michael becomes profitable overnight. This is the power of the black box. The second and third vital signs are the most advanced and impactful metrics you will ever learn. MAE and MFE. MAE stands for maximum adverse excursion. This metric asks, during the trade, what was the maximum drawdown I endured before the price went my way? Imagine your stop loss is set at 50 pips. You take 20 trades. You win all of them. You feel great. But you look at your MAE data. It shows that on average, the price only went 5 pips against you. You are risking 50 pips to survive a 5-pip drawdown. Your stop loss is 10 times larger than it needs to be. This is inefficient. If you cut your stop loss to 15 pips, you are still safe, but now you can significantly increase your lot size while keeping the same dollar risk. By optimizing based on MAE, you could potentially triple your profit without changing your entry strategy at all. You are tuning the engine for higher performance. MFE stands for Maximum Favorable Excursion. This metric asks, what was the maximum profit the trade offered me before I actually closed it? Let's say you have a target of 100 pips. The price rallies to plus 90 pips. It is almost there. Then it reverses and hits your stop loss. You lose money. You tell yourself, I followed the plan. But if your MFE data shows that 80% of your losing trades actually reached plus 70 pips before reversing, the market is screaming at you. It is telling you that your target is too aggressive. The market is willing to give you 70 pips, but you are demanding 100. If you adjust your take profit to 65 pips, you turn those losers into winners. You stop fighting the market's reality and start aligning with it. This level of analysis leads us to a concept that will fundamentally shift your psychology. The difference between a good loss and a bad win. In the amateur world, a win is good and a loss is bad. In the professional world, the outcome is irrelevant, the process is everything. A good loss is a trade where you followed every single rule in your plan. You waited for the setup. You calculated the risk. You executed perfectly. The market simply did not pay you. This is a business expense. It is the cost of goods sold. You should be proud of this loss because you exercised discipline. A bad win is a trade where you broke your rules. You felt FOMO. You didn't set a stop loss. You gambled. And you got lucky. The price went up and you made $1,000. This is the most dangerous thing that can happen to a beginner. That $1,000 is toxic. It rewires your brain to believe that breaking the rules is rewarded. It reinforces the reckless behavior that will eventually wipe you out. When you review your journal, you must punish bad wins. You must recognize them for what they are, a trap. This brings us to the Sunday ritual. You cannot analyze your performance while you are in the trenches. When the bullets are flying on a Tuesday morning, you are in execution mode. You are a soldier. You need to switch to general mode. Every Sunday before the market opens, you must sit down for 1 hour with your black box. You review every trade from the previous week. You look at the screenshots you took. You ask yourself 3 questions. Did I follow my plan? Was my emotional state stable? What did I miss? You might notice that every time you traded the pound sterling to Japanese yen pair, you lost money. You might notice that every time you traded after a fight with your spouse, you lost money. The journal connects the dots between your life, your psychology, and your bank account. It creates a feedback loop of continuous improvement. This process, plan, execute, record, review is the grind. It is not sexy. It does not look like the movies. It is boring, repetitive data entry. But this is the price of admission. The market charges tuition. You can pay that tuition in cash losses, or you can pay it in the sweat equity of analysis. The choice is yours. However, even with a perfect plan, a perfect journal, and perfect discipline, there remains one final massive barrier to entry for the average American. It is the barrier of capital. Let's be honest with the math. If you have a $1,000 account, and you are a rockstar trader making 5% per month, which is an incredible return, you are making $50. You cannot live on $50. You cannot quit your job on $50. This lack of capital drives good traders to do bad things. They over-leverage to try and turn that $1,000 into $10,000 in a month. They blow up. They try again. They blow up again. It is the undercapitalization trap. But the landscape of the US Forex market has shifted radically in the last 5 years. There is a new path. A path that allows a trader with $0 in their bank account to trade with $100,000 or even $500,000 of capital. You do not need to be rich to trade like the rich. You just need the skill. This is the world of proprietary trading firms, or prop firms. It is the great equalizer. It is the reason why a 20-year-old in a dorm room can make more money than a surgeon. In the final installment of this masterclass, we are going to shatter the glass ceiling. I am going to explain exactly how the prop firm model works, the pros and cons, and how you can leverage your skill to access institutional-level funding. We will also discuss the reality of the compound effect and map out a realistic 12-month roadmap from your first trade to your first full-time paycheck. The journey is almost complete. The destination is in sight. Imagine a world where a pilot does not need to buy their own Boeing 747 to fly passengers. They simply need to prove they can fly. If they pass the flight simulator test and demonstrate competence, the airline hands them the keys to a $200 million jet. The pilot flies the route, and the airline pays them a percentage of the ticket sales. The airline provides the capital, the plane. The pilot provides the skill. This is exactly how the modern proprietary trading firm industry operates. For decades, this door was locked. It was reserved for Ivy League graduates on Wall Street, but the internet broke the lock. Today, dozens of online prop firms offer a simple proposition. Pass our test, and we will let you trade our capital. Here is the mechanical breakdown of how this works for a US trader. You do not deposit $10,000 to trade. Instead, you pay a one-time evaluation fee, typically around $500, to purchase a challenge. This challenge grants you access to a demo account with a virtual balance of $100,000. You are given a specific set of objectives. Usually, you must generate a profit of 8 to 10% within a certain time frame, without ever losing 5% of the account in a single day or 10% of the account in total. If you violate the risk rules, you fail. You lose your $500 fee. The game is over. However, if you hit the profit target while strictly adhering to the risk limits, you pass. You are then given a funded account. This is still often a demo environment, but it is connected to a real money data feed where the firm copies your trades or simply pays you out of their revenue. The profit split is the industry standard, typically 80% to you, 20% to the firm. Let's do the math on why this changes everything. Scenario A. You trade your own savings of $2,000. You are an excellent trader. You make a 5% return in a month. That is a $100 profit. It barely pays your phone bill. You feel discouraged. You start over-leveraging to make real money, and you blow the account. Scenario B. You pass a challenge and manage a $100,000 funded account. You trade with the exact same risk parameters. You make the exact same 5% return. That is a $5,000 profit. The firm takes 20%, leaving you with $4,000. You made 40 times more money for the exact same chart performance. This is the power of leverage. It solves the undercapitalization trap instantly. It allows you to treat trading as a low-risk, high-reward career rather than a high-risk, low-reward gamble. But there is a catch. There is always a catch. Prop firms are not charities. They are businesses. They know the statistics. They know that 90% of traders will fail the evaluation. They know that even among those who pass, many will blow the account in the first month because they cannot handle the psychological pressure of trading six-figure sums. The firm makes money from the evaluation fees of the failures. Your job is to be the outlier who survives. This brings us to the compound effect, but not in the way you usually hear it. Einstein called compound interest the eighth wonder of the world. In trading, we usually talk about compounding money, turning $1,000 into $2,000, then $4,000. But the true compound effect in a professional career is the compounding of competence. When you first start, your learning curve is vertical. You are overwhelmed. But every mistake you survive, every journal entry you write, and every chart hour you log compounds your intuition. In year 1, you might only break even. In year 2, you might make 20%. In year 3, with a funded account and refined skills, you might make 20% on a $200,000 capital base. The exponential growth comes from the scalability of the market. Whether you are trading 1 lot or 100 lots, the button click is the same. The mental effort is the same. The chart is the same. The only thing that changes is the number of zeros in your bank account. So, what does a realistic path look like? If you start today, where will you be in 12 months? Let's map out the trajectory of a survivor. Months 1 through 3, the education phase. During this quarter, you are strictly forbidden from opening a live account. You are consuming this masterclass. You are reading the classic texts. You are learning the software. You are backtesting your strategy on TradingView. You are finding your identity. Are you a scalper or a swing trader? You are building your trade plan. Your goal is not to make money. Your goal is to not lose confidence. Months 4 through 6, the data phase. You open a demo account or a very small live account with money you can afford to burn, perhaps $100. You are not trying to grow this account. You are trying to execute your plan perfectly. You are building your black box. You are generating the statistics. Win rate, risk to reward, MAE/MFE. You will likely lose money during this phase as you grapple with live emotions. That is fine. You are paying tuition. Months 7 through 9, the evaluation phase. You have 3 months of consistent data. You are not profitable yet, but you are not blowing up. You are breaking even. Now, you buy your first prop firm challenge. You do not buy the $100,000 challenge. You buy the cheapest one available, usually $5,000 or $10,000. You treat it as a final exam. Statistically, you will likely fail your first challenge. You will get nervous. You will rush. You will violate a drawdown rule. Do not quit. Analyze why you failed. Was it the strategy or the psychology? Fix it. Try again. Months 10 through 12, the funded phase. You passed the challenge. You now have a live funded account. The most dangerous moment in a trader's life is the day they get funded. The tendency is to think, I made it. I'm rich. You start calculating how to spend the money. Stop. You haven't made a dime yet. You only get paid if you keep the profit at the end of the month. Your goal in month 10 is not to make a fortune. It is to make 1%. Just 1%. Secure the first payout. Prove to your brain that the system works. Once that first wire transfer hits your bank account, even if it is just for $500, something shifts in your soul. The numbers on the screen become real rent money. From this point forward, the goal is simply repetition. You are a factory worker. Your job is to pull the lever of your strategy, day in and day out, regardless of how you feel. Forex trading is often sold as a lifestyle of beaches, laptops, and freedom. That is the marketing. The reality is a lifestyle of discipline, solitude, and extreme accountability. The market is the ultimate mirror. It reflects exactly who you are. If you are undisciplined in your life, you will be undisciplined in your trading. If you are impatient with your family, you will be impatient with your entries. To master the US Forex market is to master yourself. It requires you to kill your ego, suppress your greed, and conquer your fear. It is the hardest way to make easy money. But consider the alternative. The alternative is trading your time for money for the rest of your life. The alternative is asking a boss for a raise. The alternative is being capped by a salary. In Forex, there is no cap. The liquidity is infinite. The opportunity is daily. The only variable is you. You now have the roadmap. You know the players, the banks. You know the vehicle, the broker. You know the fuel fundamentals. You know the map technicals. You know the rules, risk management. And you know the destination, funding. The video ends here, but your work begins now. Do not just close this tab and watch a cat video. Open a chart. Draw a support line. Calculate a position size. Take the first step into the arena. The market is open. Good luck. Shutterstock. Explore.